I'd like to conclude this section on financial ratios by talking about operating efficiency ratios. By this time you realize that there are many ratios. We talked about the common size income statement and common size balance sheet, profitability ratios, DuPont analysis, liquidity ratios, leverage ratios, and now we're talking about operating efficiency. Operating efficiency is primarily concerned with turnover, how long a time it takes for a given asset to be replaced. Assets take up financing. The financing is expensive. So if we can reduce the assets, we then reduce the financing. We're going to look at the components of the working capital requirement. The major accounts of non-cash short-term assets are accounts receivable and inventories. One is interested in analyzing the speed at which accounts receivable and inventories turn over. Accounts payable is a free form of financing. Other liabilities, short-term debt, long-term debt, and equities are contributed by investors who actually wish to invest in the firm to make a profit. Accounts payable are simply the amounts that we owe to our suppliers. Our suppliers don't wish to invest in our firm, but our suppliers are forced to invest in our firm through the industry practice that allows us to pay later for supplies that we receive now. From this point of view, if accounts payable are truly free, it is in our interests to maximize the accounts payable in order to minimize the working capital requirement. So the ratios that we're going to be looking at in operating efficiency concern inventories and accounts receivable as well as accounts payable. Sinopec's inventory turnover is 11.38 times. So that means if you take the cost of goods sold and you divide it by the average inventory, you'll come out with the number 11.38. We can express that in terms of days sales in inventory. Days sales in inventory is simply the reciprocal of the inventory turnover times 365 days. On average, its products are kept in inventory for 32 days. We can similarly calculate a receivables turnover. The receivables turnover is simply the sales divided by average accounts receivable. Notice that for receivables turnover we use the revenue because accounts receivable are measured at the sales price in the accounting statements, whereas for inventories we use the cost of goods sold because inventories are recorded at the cost of goods sold in the balance sheet. We can express receivables turnover in days of sales receivable. Similarly, we take the reciprocal of the receivables turnover and multiply it by 365 because there's 365 days in the year, and that gives us the number of days that it takes for a receivable to go through our balance sheet. On average, we hold receivables for 10 days. We can do the same calculation with respect to payables. That gives us then a turnover of 11 times. Payables turn over on average 11 times per year. Days payable is simply the reciprocal of the payables turnover times 365. So on average we take 31.36 days to make payment to our suppliers. We can look at the whole of net working capital and we calculate a turnover from that. Notice that for Sinopec this is a negative number. Why is it a negative number? You'll remember from Sinopec that its working capital requirement was negative. In fact, for Sinopec its accounts payable are greater than its accounts receivable plus inventories. That means that Sinopec gets net free financing from its suppliers. Finally, we can calculate an asset turnover. This asset turnover looks at total sales divided by average assets. So this is the assets at the beginning of the year plus the assets at the end of the year divided by 2 to give us the number of times that assets are turned over every year. And for Sinopec, they turn over almost twice per year. Hoffmann La Roche has a much lower turnover. You can see that inventories turn over only about twice a year, whereas for Sinopec they turned over 11 times. Receivables turn over only about 5 times per year, whereas for Sinopec they turned over 35 times. Now you might say, well, that's because Hoffmann is a drug company and Sinopec is a refiner of oil. And you'd be right. So it makes a lot of sense when you're looking at industry ratios to compare like with like, to go into a company and compare it with other companies in the industry. We went to a website, Morningside, collected Roche's data for its days of sales outstanding, inventory turnover, payables period, and found out that on average, when you compare Roche with the industry leader Pfizer, we found out that Roche had higher turnover and less days in inventory than did Pfizer. It had about the same days of sales outstanding, and its payables period were substantially less than for Pfizer. So it was able to get less free financing than Pfizer. I've been using the word free financing rather too freely, and the reason why is that trade suppliers often give a discount if they make payment earlier. For example, the supplier may offer us terms of 210 net 30. 210 means that we get a 2% discount if we pay in 10 days, and we have to pay the full amount if we pay in 30 days, and we must pay in 30 days. Now we can calculate what the implied interest rate is by using this simple formula. The implicit rate for trade discounts is the full payment divided by the discounted payment to the power 365 divided by net days minus discount days. Going back to the example that we just looked at, 210 net 30 means that we can pay $100 in 30 days, or we can pay $98 at the end of 10 days. That should be raised in order to convert it to an annual rate of interest to the power 365 divided by 20. Why? Because this is 20-day financing, and there's 365 days in a year. And then, of course, we subtract from that 1.204 to the power 18.5 minus 1, which is equal to about 44.6%. So in summary, when we study operating efficiency, we wish to turn over assets more rapidly and liabilities more slowly to save equity and debt capital. Ratios of companies should be compared to companies in similar industries to make appropriate comparisons as to what constitutes inefficient or efficient use of resources. And the free financing of payables may come at a very high price if there are discounts or other costs to those payables, and so they should be analyzed very carefully.